Welcome to the ETF Show, taped right here at the New York Stock Exchange. I'm your host, Kristen Myers, ETF Editor-in-Chief at Asset TV. Now, healthcare costs have been on the rise. Listen to this. It cost in 2025 an average of $35,000 for a family of four, and that is almost triple the $12,000 that it cost in 2005. And that is more than a 6% increase over the CPI, the Consumer Price Index. Now, healthcare remains one of the largest expenses for retirees. Now, according to the Milliman 2025 Retiree Health Cost Index, the average 65-year-old couple retiring today will spend nearly $600,000 on medical costs in retirement. So, what can be done? Well, Milliman hopes to do something about it through its first ever ETFs that aim to hedge against the rising healthcare costs. We have the Milliman Healthcare Inflation Guard ETF and the Milliman Healthcare Inflation Plus ETF, which have started trading today on the New York Stock Exchange. So here to discuss more is Adam Schenck, Principal and Managing Director of Fund Services at Milliman. Adam, thank you so much for joining us today.
Thanks for having me. Excited to be here.
So a pretty exciting day. First funds, first ETFs for Milliman that are now trading today. So let's just take a step back. I want to kind of look at the bigger picture. As I just mentioned, healthcare costs have been rising faster than inflation and for decades. But investors really haven't built their portfolios, it seems, around this risk at all. Why hasn't it been treated as an investable problem until now?
Well, it's very difficult, right? A lot of those claims costs, those metrics that you talked about are from claims, right? That's a relationship between a patient, a doctor, and their insurer. So unlike oil or other things that you could hedge because you can get a barrel of oil delivered to your house and then resell it, can't really do that with healthcare. So what we've done, and this is a 3-year product in the making, is looking at all that data inside the claims. We have a series of indices we publish called the Milliman Health Trend Guidelines, and we look inside that data to find what is driving the claims. Is it more pharmaceuticals in any given month, or hospital visits, or professional services? Then we find a basket of securities that, in our view, has the highest likelihood to correlate with those going forward. And for the Guard ETF, we try to shoot right at that bogey. But for the Plus ETF, we try to have excess returns above the bogey for people that can take more risk earlier in their investment lifetime.
So obviously talking just a little bit about what's going on under the hood, I do have a couple questions on the strategy that I'm going to ask you about. But I'm curious to know the way that these funds are going to be working. Are they just trying to keep up with the rising cost of inflation, or are they actually trying to generate excess returns over some of that healthcare inflation that we're seeing?
Sure. Depends on the product. So the Milliman Healthcare Inflation Guard, MHIG, that one tries to keep up while minimizing risk,
Okay.
right? Because you could invest in the NASDAQ and outperform
Right.
the level of healthcare cost inflation historically, but at any given point in time, you might be off by something like 50% in the worst drawdown of the NASDAQ. So we can't have that, right? We
Right.
can't have either an institution or an individual investor that's trying to keep up with healthcare experience that drawdown. So Guard is right at the bogey, so it seeks to meet the level of healthcare cost inflation as measured by the Health Trend Guidelines indices. And the Plus ETF aims to exceed over time by necessarily taking more risk in equities, primarily in the healthcare sector, in order to generate that objective.
And that was actually going to be my next question, right? Are you investing primarily in equities? Is it primarily the healthcare space that you really are focused on inside of that ETF?
Sure. So we have essentially 3 sleeves for both ETFs you can think about. So we'll talk about the lower risk spectrum. So the de-risking sleeve we use is treasuries.
Okay.
And you can think about the treasuries as trying to keep up with wage inflation, because wage inflation permeates everything in terms of, driving up costs, obviously, for healthcare. So that's the de-risking bucket. Then the risk assets are, we have a liquid alts bucket as a diversifier. That's primarily gold at the moment.
Okay.
And until we find something that can replace gold, it'll likely be gold going forward. Then equities. And then the equities are primarily in the healthcare sector, but we don't just take the healthcare sector market cap weighted like, some of the sector ETFs do. We actually look in the claims data, and then we find out how much, as I mentioned, is being driven by pharma, by hospital visits, and by professional services. And then we try to map the equity sector and healthcare to those buckets to get about the same attribution and to deliver kind of the same return through the forces that are pushing those buckets. And then we do have a layer of broader equities we call the supply chain, right? Everybody needs Microsoft, everybody needs, so there are some of those equities in there, but primarily healthcare. Supply chain's around 10% roughly. Healthcare is the rest of the equity bucket.
So you're kind of touching on it a little bit, and I'm kind of curious to know, because you guys are an actuarial firm, and I want to dive into that
Sure.
in a second, because I think it's coming through right now as you're
Yeah.
talking a little bit about the strategy. But even though healthcare costs, they're on the rise on average, they still are fairly personal, right, for every individual. So then, how can an investor really be sure that something that is so broadly market based, right, can actually track the real world costs that they themselves are facing when it comes to those healthcare costs?
Sure. So, necessarily healthcare is very personal, and someone's individual costs may run at a higher rate than someone else's, for sure. We can't really get to that level of specificity in these ETFs because this is, one ETF, essentially two ETFs we're launching. However, the way we can help people understand their specific healthcare cost needs is by financial planning tools. So we're going to launch and it's actually available on our website today, a free calculator where you can go and you can put your age, your current age, the age you expect to retire at, your retirement state, and then your health status on 1 to 5 stars. And it will spit out essentially how much, an estimate of retirement costs upon your retirement date. So, for me, that's on the order of 20 years. But then it gives you the present value of those costs in today's dollars. That's where we think you should invest that in something that is tracking what you're exposed to, which is inflation along the way. So that's really how we can help people use these in a personalized way. Although we can't match their individual costs exactly, we can help them at least try to do something, because in our view, not enough people are setting aside specific funds for healthcare costs and retirement.
How do you see this ETF really sitting inside of a portfolio? Is it, an equity replacement? Are you thinking of it as a
Sure.
thematic? How should, investors really think about that?
Yeah, so it goes back to, we think you should have a sleeve dedicated for saving for healthcare. I mean, why do we all save, right? The three basic needs when we retire are food, shelter, and then healthcare. So we think you should just have a sleeve of that. So in terms of working with someone's, you can work with your financial advisor to figure out where should this come from. We certainly think that should be a core holding. And that's why we've designed these portfolios to be risk managed, so that moving from a blended portfolio to these is not a big leap.
So then, what type of investor do you think this is best suited for, right? Naturally, in my mind, I'm thinking someone that might skew a little bit older and is actively thinking about their retirement. Is that how you guys are also seeing it? Who do you think this actually works best for?
So that's why we launched two.
Mm-hmm.
We launched the Plus ETF for people to start when you're earlier, because
So
obviously, me as well. If you think about it, if you have a longer period to save, you can afford to take more risk. And that's why we have one that does that, that takes more risk, but you should still hitch your wagon to the industry largely that you're going to need when you get older, right?
Right.
And then you also have the risk of, if something happens, then you may need that money earlier, right? So that's why we have two. We think that earlier, career people, younger folks that are healthier and have the ability to take more risk can use the Plus, versus folks that are getting close to retirement or in retirement would likely choose the Guard.
So one thing that I want to circle back to, when you were talking about the de-risking sleeve that exists inside of the fund that you said is invested primarily in treasuries, I
That's
believe.
right.
So we have currently $8 trillion sitting in money market accounts. A lot of folks are turning to cash alternatives. instead as a sort of purchase protection right now. I'm curious to know how you're thinking about these funds that you have compared to that strategy as a sort of solution in terms of this rising inflation that we're seeing.
Sure. So the current trend that we're measuring in our guidelines as of that data is lagged for the one that's published. So the current trend is running at about 7% as of 5 months ago when we are able to crystallize that number. And current treasuries aren't paying, maybe a smidge over 4%. So that's a big gap that you must try to close. And that's why we think that you should take that money, get it off the sideline, and then do something like this so that you can just try to keep up because the gap is wide. Now, these ETFs do that automatically every single month. So every single month we get the new number. And if the trend does fall lower, then we can take risk off the table. But right now, we must try to get to that higher boat.
In your mind, was there an alternate strategy that investors were using that this can replace? Or do you think that this is actually a solution to a problem that folks were never even thinking about inside of their portfolios?
I don't know many people that were thinking about this in their portfolios. And that's why, as we were thinking about this initially for institutions, and we have many institutional clients that we hope will use these, and we have various ways that we're going to, package these strategies for institutions. But we thought, and this is part of our mission statement, to serve our clients to protect the health and financial well-being of people everywhere. That people everywhere part is where we thought, let's put these out for public consumption so that people can try to do something about this problem that literally everyone has up and down the spectrum in the United States.
So I want to ask about Milliman, right?
Sure.
It is not an ETF issuer. No one has heard of it as an ETF issuer. It is an actuarial firm. I'm curious to know what advantages you think that really brings to the table as you've already built out this sort of first entree into the world of ETFs.
Sure. So, founded in 1947 by two pension actuaries, and since then we've grown to almost 1.8 billion of revenue, but largely in consulting, largely in actuarial functions. So, um, as I sit here, I co-lead our investment advisor, and we've actually been helping life insurance companies since 1998 to hedge the risk that they've generated on their balance sheet by selling products linked to markets with investment guarantees. So we've been doing that all along. We were doing that during the financial crisis. We estimate we saved the insurance industry about $40 billion in that event. And so we have that institutional risk management piece. And then 3 years ago at a breakfast, I met some of our health actuaries that I wasn't working with historically before. Health is one of our largest disciplines in terms of revenue. We call them disciplines, areas of focus. And they have all these data assets. So I thought, well, we can design a strategy around this data, the claims data, the indices that we produce. We have another data asset on the pharma side for pharmaceutical sales, literally by drug, for every drug that goes in the bodies of people in the United States. So all of that expertise on the actuarial side, and you'll see some of my colleagues, in different interviews or just around today and as we launch these products. But a lot of that goes into all this. Literally, the first guidelines were published in 1956, and now we're still doing that today.
I'm curious to know why you think some other asset managers haven't done this before. This seems like a huge opportunity.
I think it really is the data assets and then having the know-how to interpret the data the right way and then be able to apply it the right way for people to make it easy for the individual and then also to build products that have a dual purpose so that we can help our clients as well and then also help individuals.
There obviously is a downside to everything. I'm curious to know what you think some of the biggest risks or the biggest misconceptions might be from the investor, really, as they think about some of these strategies as perhaps some kind of golden bullet or cure-all for the rising healthcare costs that they're facing, just inside their own homes.
as I mentioned, right, we cannot track this exactly because that all those payments go through all these intermediaries necessarily because that's, a protection for people to make sure that they're getting the right care. So we can't be in a position to hedge these directly. So there will be periods where these products may not meet the trend because a lot of assets are declining and you do need price appreciation in these. But what we're doing is stacking the deck as much as we can in our favor in these products to participate in gains in the securities when inflation is increasing.
Adam Schenck, Principal and Managing Director of Fund Services at Milliman, thank you so much for joining us today. And thank you for tuning in to the ETF Show.